Welcome back to Real Property Tools video tutorial. In this video we're going to go over my favorite part of the software. It's just the bottom section, the first tab, which is the investment model. Investment model, this is a snapshot complete with a graph, kind of a picture representation of the entire investment over the term. You can find backup for this in the cash flow schedule. So the cash flow schedule has all this information by year, broken down by costs, acquisition, disposition, income, expenses, returns, and then summaries. So that's all there if you want to look at by year, but then here's basically the snapshot though, that total year turn. There are seven inputs. The acquisition costs, I mentioned, that's when you buy this property, there's going to be fees for loan origination and closing costs. We put in 2.5%. Hold term, we're leaving in 7. Stabilization month, this month represents how long we project it will take before we can move rents from current, up here, to pro forma. Rent growth, expense growth. Usually these track or parallel in some form or fashion inflation, but there's companies out there that'll give you historical rent expense growths for different markets. I believe one of the companies is REIS. They have some data that's pretty good. In general, though, we're going relatively conservative based on what they're projecting. We're putting in 3%. It's been less before. It can be, obviously. You can choose whatever you'd like. Terminal cap rate. This is what we believe we'll have to sell the property for. What cap rate we'll have to sell the property for. In this part of town, we think 7.5, maybe even 7.25. We might be able to drop it down to. Probably won't be able to sell for any more of a premium. And then disposition cost. That's mostly brokerage fees. You probably can get less, but I think that's conservative. Based off of all those assumptions, that's going to be a disposition price, 175 at 7 years, and it's going to be a disposition price per unit, which is more of a metric. When we look at this and we say, can I actually sell this building in 7 years for 103 unit? Go up here, I'm like, well, we're buying it for 76, and it's going up to 103. I don't think we can do that. So let's see what it looks like in 93 unit. Yeah, that's doable. A 7 at an 8 cap to sell it at, but I think that's doable. So that's giving us a little bit more room. That all said and done, it gives you a total profit and loss. All that is just the number you get when you disposition price minus disposition cost minus acquisition price. Then you have your amortization, which is your principal pay down right there in the graph. And your cash flow, which is light green. It's all cumulative too. So this last year kind of represents everything right there. That's your total return. That total return, when you the average annual cash on cash is 13.7. Your IRR is 17. It's pretty good. Let's say though, this is the fun part. While you have all this built in, if 17 is not bad, but you want to get better, what do you have to get your 20% IRR? There it is, 20.82 IRR. If you can get this deal for 1.12. Now he wants 145, so that's probably unrealistic. 135. What would this be? 1350. It's 15.8. That's not the best. So you can tweak this. Let's say you want to change your rent growth or change your cap rate. Let's say you can definitely get it 7.5. Maybe you want to hold the term for only 5 years. Usually the shorter your term is, the quicker you can make your money back. Your IRR usually will reflect that better. So now your disposition is at 94 a door. That's 7.5. Let's say 7.25. 18. So you see how it is. You play with this until you get the numbers you want. That and your price. Okay, that's really truly the power of this tool.